Is there a point where you stop underwriting for that cap rate expansion?
There might be, but we haven't reached it yet, as far as we're concerned. Right now, the cost of debt is still significantly higher than the average cap rate in multifamily. That type of inversion is not something that typically would persist for a very long time. So that means either pricing has to come down, which means cap rates expand, or interest rates come down. I think it could be a little bit of both. So we still are underwriting the cap rate expansion because when we look at, and it's a bit of a hedging strategy, when we go forward on a kind of a macro high level picture, we think it's very low odds that cap rates are going to be significantly lower at any point in the foreseeable future. We've got so many secular inflation pressures, and people got way too used to the super low rates from the last 5 to 6. That's not normal. That was way below mean. And unless we get into a severe recession, which will cause its own issues, we're not expecting to see interest rates or cap rates at that point again, where you got B and A class assets trading in the threes and low fours. So we don't think cap rates really have a whole lot of room to go down further, at least not in the B and the A stuff. Our base case is that cap rates probably stay about the same for the next 3, 4, 5 years. Now, and the reality is we can't predict what the cap rates are going to be 3 months from now. But just so take this with an entire shaker full of salt. All basically the general principle is the odds of cap rates significantly moving back down again seem pretty low given the macro factors that are out there. There's a pretty strong case for them to just stay where they are, which is very workable. But there's also a non-zero, and I would almost say meaningful risk that cap rates are higher in the future. And cap rates, your exit cap rate is one of the biggest levers that goes into underwriting. And now, candidly, that's how a lot of sponsors put out pro formas that look great, but then eventually don't perform, is because it's based on an exit cap in 5 years. That's not going to happen. And so, yes, that will probably knock you out of deals, especially if the other guy's factoring in even or even to lower cap rates. But I'd rather regret the deal I didn't do than regret the deal I did do. And so, yeah, we're still factoring in cap rate expansion because it's a hedge against the worst case, which if you got a deal that works with cap rate expansion built into it, odds are you're going to be in pretty good shape because either way you win. If cap rates go down and you're wrong, you're going to be blowing your numbers out of the water. Cap rates stay the same, you're good. If they will go up, you already planned on it.